Red flags. How do you know when the financial sector is in trouble and the wider economy might be in trouble? Well, there are a number of indicators that keen investors will watch, and in this video I want to cover one. It's called, wait for it, the LIBOR OIS spread. Now, if you're still watching after all that lot, well, let's have a look at what it is, how it reveals that part of the engine room of the economy, the banking sector, might be in big trouble, all right, and where you can get information from. One or two aspects of this video I cover in other videos, so I'll reference those as we go along. Right, that name again, the LIBOR OIS spread. Let me write that down. So LIBOR OIS spread, quite a mouthful. Yet another piece of financial markets jargon. Now, as everyone knows, a few years ago the banking sector kind of exploded. We had banks disappearing, names such as Bear Stearns, Lehman Brothers and so on, and one of the ways that you could have spotted all that trouble emerging was to watch this thing. A bit of a technical indicator, and try and explain what it does. It's quoted in the press quite a bit at the moment, so it's worth knowing roughly what it does and how to interpret it. Right, for the techies out there, this will be an unsatisfactory video. All right, I'm going to keep this nice and basic for anyone who's a plain vanilla investor who wants to know, right, there's a warning signal out there that the banking sector's in trouble. How do I interpret it? Okay, that's the aim of this video. So, what is the LIBOR OIS spread? Right, let's break it down. Spread means gap between two things. So the two things are two interest rates. Okay, now, LIBOR, I've done another video called Britain's Most Important Interest Rate. So if you're not entirely sure about LIBOR, take a look at that video maybe before you tackle this little section. But basically, LIBOR is an interest rate. It's the rate that banks estimate they'll be able to borrow at for different periods of time in the interbank market. All right, and those periods of time could be 1 month or 3 months, and 3 months is a very typical period over which banks might want to borrow. Okay, so basically a panel of banks is asked to estimate that rate. Those results are then amalgamated by the British Bankers Association, and you have one rate, the rate at which the market, that is banks in the UK market, it's called the London Interbank Offer Rate, think they could borrow at for say 3 months. Right, on this side, overnight index swaps. Overnight index swaps, all right? Now I'm not going to go into the full detail of the contract for this video. See what is a swap if you've never come across a swap before. Doesn't matter, don't panic. The point is this, okay? The very shortest amount of time as a bank you could leave money on deposit for is overnight. So there is an interest rate called the overnight interest rate, okay? In fact, there's one called the sterling overnight index average rate, SONIA. There's a euro or European overnight index average rate, EONIA. What's that? That's banks estimating what it would cost them to borrow or lend overnight, literally overnight, okay? Now, here's the point, all right? Which one of those two things, borrowing for 3 months or borrowing overnight, is riskier? Borrowing for 3 months. Why? Because your counterparty could go bust, all right? 3 months is a long time. Overnight, you can be fairly confident things aren't going to go too badly wrong, all right? I mean, it might just be your counterparty disappears overnight, but probably not. So, on that basis, if you were to take, say, the 3-month LIBOR rate and compare it to the rate in a contract that takes the next 3 months' estimated individual overnight rates and adds them together, you'd expect a bit of a gap, but not a huge gap normally. That's the spread. Why? Because if there's a huge gap between the two, someone would say, well, I'll just borrow at the lower of those two rates, the overnight rate, and lend out at the higher one, LIBOR, and I'd make easy money if no one goes bust. All right? So you wouldn't expect there to be a huge gap, but there is a gap because of risk. Overnight borrowing is less, and lending is less risky than, say, 3-month periods, all right? Which again, less risky than 6 months or a year, all right? So here's the point. This beast of a thing, LIBOR, that's the London Interbank Offer Rate, to overnight index swap spread measures essentially risk in the markets, because it says the wider the gap between what people estimate they could keep putting money on deposit for 3 months, as opposed to one rate negotiated for a full 3 months, as those two rates start to diverge, what does it mean? Either the market is gifting what we call an arbitrage opportunity to people who borrow at one and lend at the other and clean up, or more likely, fear is stalking the banking sector. People are getting more and more and more worried about lending over any length of time. So they're basically preferring the overnight rate. Okay, the overnight rate's kept nice and low, and the gap between it and the 3-month LIBOR rate is gradually drifting. So to put that in context, if you were to put that on a graph, all right, normally the gap between, let's say, the LIBOR rate and the overnight rate okay, expressed in this case as a contract that compounds overnight rates into a 3-month rate, you'd expect it to be reasonably tight, but you'd expect LIBOR to be above the overnight rate, and that's indeed the case, by about, typically before the credit crunch, 10 basis points. That's the spread, that gap. 10 basis points isn't very much, by the way. It's basically 1/10 of a percent. There's 100 basis points in 1%. So the gap between the two rates is quite tight. What happened around the Lehman Brothers disaster 2008, you had this kind of thing happening. This line went wee like that, and has sort of ever since then vaguely crept back. So you've kind of had a huge gap open up, all right, and then we've maintained a bigger spread ever since, and that'd be about 2008. Well, I'm not being too precise here. Okay, how big did the gap go? How much fear was in the market? Well, the answer is it ballooned out to more like 350 basis points. All right, in other words, the gap between the safe overnight rate and the riskier period LIBOR rate ballooned out to 3.5%, right? Which doesn't sound like a lot, but it's a heck of a lot more than just 10 basis points, 1/10 of 1%. Right? Why? People suddenly panicked. The interbank market, people were saying, we don't trust other banks, we're not lending for any sort of length of time without charging a huge premium. The interbank market effectively sort of closed down, okay, as people said, right, well, the longest we're prepared to lend for is overnight, all right, or we're prepared to do very short-term deals, we're worried. If people want to borrow for longer than that, hike up the rate. All right, now, the gap, and I say now, as in when the video is being shot, okay, midway through 2012, the gap's between 30 and 40 basis points. All right, so 3 or 4 times where it sat for quite some time before the credit crunch, all right, but still a way down from the panic fest that was the Lehman Brothers collapse. Again, that's because steps have been taken since then to try and stabilise, to some degree, the interbank market. But it's worth watching. It's kind of at the engine room of the banking sector, all right? When that rate spikes, trouble, all right? You can expect interbank market to be closing up, okay, banks not lending to each other. You can expect central banks to start panicking about how they're going to rescue and open up the interbank market. Now, obvious question is, if you've got all of that, or at least some of it, where do you get the information from? The answer, I'm afraid, if you haven't got a Bloomberg terminal or something similar, okay, or access to Reuters data, it is not easy to get it fresh, you know, off the plate, as it were. But all you've got to do, frankly, most days, easy tip, is stick the phrase LIBOR OIS spread into Google News and hit return. All right, and you will get an article pop up reasonably high, might be Bloomberg data. You'll be able to pick off from their website data about this spread, which is maybe not right up to the minute accurate, but at least will give you a flavour for where that spread is heading. Okay, and there are 1 or 2 other possible website sources, but I say they tend to be subscriber based. So there we have it, a red flag indicator of trouble in the middle of the banking sector, and in later videos I'll deal with 1 or 2 more useful red flags for investors.